All right, well, we're going to go ahead and get started. Again, thank you for joining us today for our Sacramento Public Company Roundup discussion. I'm Mary Isley, the Marketing Manager at Downey Brand. I will be monitoring things this morning and introducing you to our host, James Wigginton. But first, just a couple of housekeeping items. We will be using the Q&A feature during the webinar. If you have questions, please type them into the Q&A tab, and James will answer them either during the presentation or afterwards. Also, the webinar is being recorded and will be available on our website and on our YouTube channel, along with the slide deck. And now, it's my pleasure to introduce you to James Wigginton. James is an attorney in the firm's corporate group, where he advises on a wide variety of matters, including public and private acquisitions, registered and unregistered debt and equity offerings, compliance with federal security laws, and corporate governance. James graduated from Stanford Law School in 2013 and worked for Sullivan and Cromwell and the U.S. Court of International Trade before joining Downey Brand in 2020. I would also like to note that James is a third-generation Sacramento native. It's all you, James. Thank you.
All right, marvelous. Thank you so much, Mary. I am so excited to be with all of you today. I've been looking forward to this for a long time. And as Mary said, I've been with Downey Brand for about 1 year now after working at Sullivan and Cromwell in Los Angeles. And down at Sullivan and Cromwell, I focused primarily on large M&A acquisitions in public companies for clients like Amazon and AT&T and Columbia Banking System, among others. And in the time that I was away from Sacramento, a total of 16 years, I was in New York and Palo Alto and England and Utah, and even for a short time in Ukraine. But before leaving on all of my big adventures, I didn't really have much exposure to Sacramento's business community. I guess I was kind of a typical oblivious teenager. I thought Sacramento's a government town, right? And I think maybe Blue Diamond is headquartered there. But when I moved back with a little bit of Wall Street experience, I was delighted to find a thriving business community. And I think I was even more surprised to find a critical mass of public companies right here in our own backyard. And I think many people haven't even heard of them. So hopefully we'll get to know them today. And here are some of their trademarks. So after coming back to Northern California and starting to work at Downey Brand, I perused the Sacramento Business Journal, which is super helpful, and also the Securities and Exchange Commission website. And I thought I had found a pretty stable set of local public companies that I could introduce myself to. So you see some of them here, like Alto Ingredients and Arcadia Biosciences and Sunworks, among others. But then at the beginning of 2021, something happened. It was like Sacramento's public companies community just exploded overnight. And we had some new entrants. Just a few months ago in February, Origin Materials, which is a carbon negative materials company founded by a UC Davis grad, announced that it would join the public company family via a SPAC merger, or a merger with a special purpose acquisition company. And then in April, within 3 days of each other, PowerSchool, which is an educational technology company in Folsom, and Star Bank, which is a highly regarded commercial lending institution in Roseville, filed registration statements for their initial public offerings also. So in just the space of a few months, Sacramento's public company class had grown by almost a third, which is really pretty remarkable and unexpected growth. Now, with these really kind of stunning developments, I, like many of you, questioned, what's going on here? Is this trio of IPOs some sort of a flashing neon sign that Sacramento is coming of age as a national and international business center? Or is this just a coincidence? And this is the question that I would like to explore with you for the next 45 minutes or so. We're going to look for some common threads among these newly public companies. Are they in similar industries? Have they reached a similar level of growth and profitability? Are they going public for similar strategic reasons? My hope is that these questions and answers will kind of help us determine what to expect from Sacramento's businesses in the future. And after that, of course, as Mary said, I'll be taking some questions from the audience, so please don't be shy. And please also don't be shy to ask questions during the presentation. This is supposed to be a survey, right? I can't possibly cover all of Sacramento's all of Sacramento's public companies in 45 minutes. So if you have insights to offer about any particular company, please let me know, because I think your insights are going to be really valuable. All right, so to answer this question, is Sacramento coming of age as a national and international business hub? We are going to proceed as follows. In part one, we're going to get to know Sacramento's public company community. And for purposes of this presentation, we're only going to be discussing companies that have equity securities registered with the Securities and Exchange Commission and which file periodic reports like 10Ks and 10Qs. There are other companies in Sacramento that could be considered public that don't file reports. And by that, I mean like River City Bank. It's a more widely held company, but they don't file with the SEC. So they're not going to be included in the sample, but River City Bank, we still love you. So please stick around. And then in part two, we're going to discuss some general reasons why companies go public. And the principles we develop in part two are going to help us as we move to part three, which is where we'll discuss the IPOs for Origin Materials, PowerSchool, and 5-Star Bank. And at that point, we're going to learn the lessons that we're going to use the lessons we've learned to assess whether there are any commonalities among these IPOs that indicate that these developments are part of a trend rather than just one-offs. So let's go ahead and jump in. All right. Here in part one, we're going to spend some time getting to know the public companies in our own backyard. We're going to talk about where they're located, what they do, and how their businesses compare to each other. So here is a map. I love maps. You'll see here that our public company community covers a very wide geographical area stretching from Chico in the north to Lodi in the south. And we chose this sample because for these companies, Sacramento is the closest major business center. And we could have expanded this map to include other public companies like Plumas Bancorp or Bank of the Sierra, but these companies gravitate towards other business centers like Reno and Los Angeles. So that's why we only focused on these. So next, what do these public companies actually do? As you can see, they fit into an array of industries, and the plurality, 5 of the 13 companies, including 5-Star Bank, are actually local banks. The others are in a range of industries from agricultural inputs to chemical manufacturing to solar. And because Sacramento sits at the heart of the Central Valley, the nation's fruit and vegetable basket, I was a little bit surprised that there weren't more public companies in agriculture, but that's not the case. And only one of them, and that's PowerSchool, is a pure play software company. So we have a very different mix of public companies in Sacramento than you might find in the Bay Area or in Los Angeles. So now let's compare these public companies and almost public companies to each other. Here in this slide, you see a snapshot of the public company's revenue in 2020. And Alto Ingredients leads with $897 million in revenue in 2020, followed by PowerSchool with about $435 million, and then Trico Bankshares, which is a Chico-based regional bank, is in third place with $308 million. 5-Star Bank, which just went public, sits in fourth place with a 2020 revenue of about $81 million, which puts them in the middle of the pack among its regional bank peers. And I thought it was interesting that Origin Materials is all the way at the bottom. And I think it's sort of a true outlier in our sample because it's the only pre-revenue company on the list. To this point, Origin Materials has entered contracts to provide carbon negative materials to customers, including Danone and Nestle Waters and PepsiCo, but it's still building its first factory in Canada, and it doesn't expect to begin commercial production until 2023. So it's going to be a while yet before Origin posts any revenue and climbs up this list. All right, now we're going to compare these companies based on pre-tax income. And you can see here that the picture and the rank order of these companies changes dramatically when you look at pre-tax income. In terms of profitability, Trico Bankshares is the clear winner with $87 million in pre-tax revenue or pre-tax income, excuse me. And the next four leaders are also regional banks. In fact, the banks were the only profitable public companies in our sample in 2020. Alto, which you'll probably remember led the pack in terms of revenue, is third to last in terms of profitability, with a pre-tax loss of $17 million. And this is due in part to Alto's strategic shift from producing fuel-grade ethanol to specialty alcohols. As part of this strategic realignment, Alto idled its Idaho facility, and it sold or is in the process of selling its remaining California facilities in Madera and Stockton. So sadly, due to these shifts, it looks like Alto is going to be leaving Sacramento. It's going to be moving its headquarters to Illinois. So eventually we're going to have to remove Alto Ingredients from our list of regional public companies. And interestingly, PowerSchool is in last place with a pre-tax net loss of $47 million in 2020. Based on my review of PowerSchool's financial statements, it seems that one of the main drivers behind its net loss is their substantial debt service. At the end of 2020, PowerSchool had $1.16 billion in current and long-term indebtedness, with interest payments in 2020 of around $68.7 million. A lot of this debt was incurred by executing their acquisition strategy. Over the last 6 years, PowerSchool has completed 12 acquisitions, and they intend to use almost all of their IPO proceeds to reduce their debt load. So now we're coming to the end of part one, our bird's eye review of Sacramento's public companies. But before moving to part two, I want to offer a little bit of perspective on what you've seen. Alto Ingredients and PowerSchool may seem like really big companies when viewed in a vacuum, but when you compare them by 2019 revenue to Sacramento's other companies, including private enterprises, it's a totally different picture. As you see here, Alto Ingredients is not at the top of the list, and it's not in second or third place either. Instead, Alto is sixth on the list with total revenue in 2019 of about 1.4 billion, just below Blue Diamond Growers and above Future Automotive Group. The next almost public company on the list is PowerSchool, which sits just below Lasher Auto Group and just above Van Housen Automotive Group with 2019 revenue of 365 million. And surprisingly, Trico Bankshares, which was our profit leader among public companies, doesn't even make the top 20. It ranks below a number of companies that you wouldn't normally consider to be in the same league as public companies, like local automotive groups and even a nonprofit. So this chart for me leads to kind of an important question, which is, if Sacramento public companies are so small, and if a number of Sacramento's private companies have succeeded without going public at all, then why have the companies in our sample bothered to go public? Going public involves a lot of upfront cost, ongoing expenses to make disclosures and complying with legal and accounting standards. So why go through the hassle? And that is our segue into part two. Why do companies go public? And in part two, we're going to talk about some of the basic reasons that companies decide to go to market. What are the benefits? We're going to spend the next few minutes discussing these benefits. There are obviously a lot more benefits to going public than we can discuss today, but here are 3 of them. Number 1, public companies have greater access to capital markets. They can use their stock as currency for mergers and acquisitions. That's number 2. And number 3, they provide a liquid marketplace that allows pre-IPO investors to cash out. So let's break down the first one, access to capital markets. As you may know, in the United States, this is me being a little bit lawyerly, it is against the law to sell securities, whether in the form of equity, like stock, or in the form of debt, like bonds, without registering those securities with the Securities and Exchange Commission, or the SEC. The registration process itself requires companies to disclose extensive information about their financial condition and management, which helps the public to make informed decisions about their investments. And there are some general exceptions to this rule. For example, if the securities are sold without advertising to sophisticated investors, or more recently, crowdfunding. But these exceptions come with limitations, such as restrictions on the dollar amount of securities sold. In order to sell to the public without those limitations, the securities have to be registered. So one of the key advantages of becoming a public company is of going through this process of registering the securities and filing reports with the SEC is access to the full breadth of the US capital markets. And a recent example from one of our Sacramento companies is Sunworks. Sunworks is a solar company, as you might have guessed from the name. And in January 2021, they filed a registration statement for what's called an at-the-market securities offering. And this type of offering allows Sunworks to sell securities, in this case, as you can see in the slide, up to $50 million of stock at prevailing market prices over an extended period. In the registration statement, Sunworks said that it would use the proceeds of the offering for general corporate purposes, but they can also use the money to acquire other businesses. It appears that's actually what happened, because on April 8th of 2021, Sunworks announced that it was purchasing Solcius, a Utah-based solar provider, for $52 million in cash. All right. In addition, public companies can use their stock as currency for acquiring other businesses. And what exactly do I mean by that? One of the primary reasons that the stock market exists is to make it easy for investors to convert their shares into cash. When a public company's shares are registered and trade on a stock exchange, like the New York Stock Exchange or the NASDAQ, anytime an investor can sell those shares and use the proceeds to fund something else, like a child's college education or a vacation to Tahiti. Because they're freely exchangeable, a public company's shares are almost as good as cash. And in fact, in the accounting world, public securities held for sale are treated as cash equivalents. A recent example of this phenomenon from Sacramento's public company community is American River Bankshares. On April 16th, 2021, American River entered into an agreement to merge with River Bankshares, which is a regional bank headquartered in the Bay Area. As of March 31st, 2021, Marin had approximately $3 billion in assets on its balance sheet, and American River Bankshares had approximately $916 million in assets. So the combined company will have a total of about $4 billion in assets, which is roughly twice the size of Five Star Bank and roughly half the size of Trico Bankshares. To fund this merger, Marin is not paying any cash at all. Instead, it's exchanging 0.575 shares of Marin stock for each share of American River stock, which equals about $19 of value per American River share. And that represents about a 17% premium over American River's stock price prior to the merger, or prior to the date that the merger was announced. So that's a pretty good deal. Interestingly, the deal announcement had somewhat the opposite effect on Marin stock, which dropped from $39 to $34, or about 13% on the day the merger was announced. And the merger is expected to close in the third quarter of this year. All right, next. Liquidity for pre-IPO investors. This is the third reason that we'll discuss. And it's really just the other side of the coin of the prior reason that we discussed. Just as selling public company shares on a stock exchange is very easy because there's a broad market, selling shares of a privately held company can be hard because buyers are few and far between. And it may take months or even years to find a suitable buyer. So one of the drivers to do an IPO may be to give current investors the opportunity to cash out their holdings and move on to new ventures. Private equity investors do this all the time with their portfolio companies. And liquidity is one of the driving forces behind the 5-Star Bank IPO, which we will turn to now as we enter part 3. The 2021 IPOs, how and why. In this last segment, we'll take a closer look at the IPOs for 5-Star, PowerSchool, and Origin. And using the data and tools we've reviewed in the last 2 segments, we'll try to determine if there are any similarities in what drove these companies to go public. So let's go ahead and continue with 5-Star. For those of you who are not familiar with it, 5-Star Bank was founded in 1999 by a group of Sacramento leaders, including Buzz Oates, a renowned real estate developer. Since then, the bank has grown through organic expansion and a series of small capital raises until it reached $2 billion in assets in 2020. But even as it grew, 5-Star's holding company remained an S corporation, meaning that the company itself was not subject to corporate income tax. Instead, the company's profits and losses were viewed for tax purposes as passing through to the company's shareholders. This arrangement ended, however, when the 5-Star IPO was consummated earlier this month. In connection with the IPO, 5-Star's holding company converted from an S corporation to a C corporation, meaning that the company's post-IPO profits will now be taxed at the corporate level as well as at the shareholder level. For the company's original shareholders, being taxed twice on the company's profits is certainly a drawback. But the benefit is that now the company's 93 pre-IPO stockholders will have a market in which to sell their shares upon expiration of the underwriter's 180-day lockup and subject to certain resale restrictions. So in short, the original investors will now be better equipped to turn their shares into cash. Of course, there may be other reasons that 5-Star went public. For example, with the intent to raise more funding in the capital markets, or to use its shares to acquire other banks, or to reward its executives with stock options, for example. But the registration documents from the IPO don't suggest that 5-Star plans to raise additional capital or to acquire another bank in the near term. Another clue to 5-Star's plans can be found in their board composition. Unlike PowerSchool and Origin Materials, which we'll turn to momentarily, 5-Star's board of directors is comprised primarily of local business leaders. And here are just a few of them that you might recognize. For example, Larry Albaugh is the CEO of Buzz Oates Real Estate. Shannon Deary-Bell is the CEO of NorCal Beverage and a former board member of Jesuit High School. That's where I went to high school. David Nickham is the CEO of Valley Farm Transport and a former board member of St. Michael's Episcopal Day School, which is where I went to middle school. As you can see here, there's kind of a theme. 5-Star Bank's board is local, and they're very well equipped to expand locally, and we're excited to see them do that. All right, now on to PowerSchool. We've established that one of PowerSchool's key objectives is in undertaking the IPO, which is paying down its substantial debt load from years of acquisitions. And here in this slide, you can see PowerSchool's very pretty headquarters on Lake Natoma. I've actually run by this run by this headquarters a number of times and always wondered what it was. And now I know it's PowerSchool. And here's also a picture of PowerSchool's CEO, Hardeep Gulati. I think, though, to understand PowerSchool's other objectives beyond just paying down its debt, it may help to review the structure of the IPO itself. So here is a graphic taken straight from PowerSchool's registration statement showing its pre-IPO structure. Leading up to the IPO, two private equity investors called Onyx Partners and Vista Equity Partners backed PowerSchool and owned interests in Severin Topco, which in turn owned 100% of the equity of Severin Holdings. Severin Holdings is PowerSchool's main operating company. And both Topco and Holdings are pass-through entities, kind of like Star Bank was prior to its IPO. Then, in connection with the IPO, PowerSchool executed a maneuver called an Up-C transaction, which is shown in this graphic. As part of the Up-C transaction, the parties created a new corporation called PowerSchool Holdings, shown in the bottom right corner of the slide. PowerSchool Holdings has two classes of stock, Class A and Class B. In the IPO, public investors will buy PowerSchool Holdings Class A stock. Then, using the proceeds of the Class A sale, PowerSchool Holdings will buy an interest in Severin Holdings. Separately, and I hope you're all following, separately, Severin Topco, which is owned by the pre-IPO investors, will maintain an economic interest in Severin Holdings, but will receive a voting interest in PowerSchool Holdings in the form of Class B shares. The Class B shares are convertible into Class A shares. Okay, so now at this point, I know this Up-C structure is confusing, and you're probably wondering why I'm subjecting you to these boring legal details. But the answer is simple. PowerSchool is undertaking this Up-C restructuring to benefit the pre-IPO investors, including Onyx and Vista. By using the Up-C structure, the original investors will get all of the liquidity benefits of holding public company shares, which can be sold for cash, while maintaining the favorable tax treatment of owning a pass-through economic interest in the operating company. So in short, the pre-IPO investors get to have their cake and eat it too. So again, in addition to paying down its debt, PowerSchool is undertaking the IPO to give its private equity supporters a tax-advantaged way of getting liquidity for their investment. All right, now finally, let's talk about Origin Materials. As we discussed in part one, Origin is an outlier because it's a pre-revenue company. It has customers waiting in line to buy its carbon negative products, but Origin still needs to build a factory for commercial production. And as you can see from this graphic, when they do start to manufacture, I think Origin is going to have a huge impact on the materials industry and reduce our dependence on petrochemicals, and that's all good. Origin is also an outlier because unlike 5-Star and PowerSchool, Origin is going public through a special purpose acquisition company, also known as a SPAC. I assume some of you have heard about SPACs in the news, and that's because an unprecedented amount of investment capital has been flowing into them during the pandemic. But how exactly do SPACs work? Let me tell you. SPACs start their lives as empty shell companies without any operations whatsoever. Then, before doing any real business at all, the SPAC has an IPO and sells Class A shares to the public for $10 per share. It's always $10. And they generally sell some warrants too, with a strike price somewhere above $10. After the shell company is capitalized, the SPAC's management team goes in search of target companies, and they examine dozens of these target companies. When they find a winner, they enter into an agreement to merge with that company. And then finally, when the SPAC and the target company merge, voila, the target company becomes a publicly traded company. And the SPAC sponsors get paid by receiving Class B shares in the company for a nominal price, generally around 20% of post-IPO equity, which can then be converted into Class A shares for a profit. This has been a very, very popular transaction structure. And as you can see from this graphic, it's been especially popular in 2020 and in early 2021. Actually, just year to date in 2021, there's been more investment in SPACs than in the entirety of 2020, which is a pretty impressive finding. There are signs, however, that the SPAC fad is fading, and we might want to talk about that at another time. All right, so the transaction structure that we just discussed, the SPAC, is what has happened with Origin Materials. In early 2020, a group of investors led by Boone Sim founded Ardius Acquisition Incorporated, which had its IPO in July of 2020. The management team then set out to find a target company, preferably in the financial services technology sector. After researching 75 different companies and doing diligence on 15 of them, Ardius entered exclusive negotiations with Origin Materials in January 2021. And the other person in this slide is John Bissell. That is one of the co-CEOs of Origin Materials. He's the UC Davis grad who founded the company. So the parties entered into a merger agreement in February of 2021. And as of today, we're still waiting to see if Ardius's shareholders will vote to approve the merger. And now I have no reason to believe that the shareholders won't approve the merger. But I do find it interesting that as of just a few minutes ago, Ardius's stock was trading for $9.96, or 4 cents below the $10 IPO price. Another feature of SPACs is that shareholders can redeem their shares for $10 per share before the merger vote occurs. And this trading price, $9.96, suggests that that could be the case for many Ardius shareholders. And if a lot of shareholders redeem their shares, then the Origin SPAC merger could yield less in terms of total proceeds than hoped. And that will make the company more reliant on private investments to build their factories and meet their other financing objectives as they go forward. So we wish them well. I hope the shareholders approve things and they're able to close. According to a fireside chat between Boone Sim and John Bissell just a couple of days ago, it sounds like the merger is going to close in the second quarter, so imminently. All right, now it's time to wrap up. In part one, we compared Sacramento's public companies to each other. In part two, we explored some of the reasons that companies go public. And in part three, we reviewed some specific reasons why 5-Star and PowerSchool and Origin Materials are going to market. And all of this was to answer just one question. What does this sudden outburst of Sacramento IPO activity mean? Is Sacramento coming of age as a national and international business center, or is this trio of IPOs merely a coincidence? And based on what we have seen, I think we can conclude the following. The new IPOs are not in similar industries. And more generally, Sacramento public companies do not seem to form an industrial cluster like tech companies do in Silicon Valley or like oil and gas companies do in Houston, for example. As a community, we're kind of all over the map. If there's a common thread among our public companies, it's really regional banking, not agriculture, as you might expect for America's farm to fork capital. In addition to that, the new IPOs are not at a similar level of maturity. 5-Star is very well developed and profitable. PowerSchool is growing, but it's not yet profitable. They have some interest hurdles on their debt to overcome. And Origin Materials has yet to earn any revenue at all. These IPOs then I don't think are an indicator that Sacramento companies have generally reached a level of maturity where they are ready to go public. And really, in this day and age, it seems like companies can go public at any point in their life cycle. Although we'll have to see what happens as the SPAC fad fades away. SPACs have really been an opening for pre-revenue companies to go public. And when that option potentially fades, that could change the ability of pre-revenue companies to come to market so quickly. Next, the new IPOs are not all going to market to pursue acquisitions of other companies using their stock. Five Star doesn't appear to have any present plans to acquire any other banks. They actually said in their disclosure documents that they want to continue growing organically. Origin Materials is using their IPO proceeds to build factories, but it doesn't look like they're interested in growing through acquisitions. And I think only PowerSchool is likely to use its stock to purchase other businesses in the near to medium term, but I haven't heard any announcements to that effect. And next, I don't think that the IPOs have announced an intention to use their public status to raise any additional capital in the near term. If there is a commonality among the IPOs, I think it's that they are all structured to give liquidity to their pre-IPO investors. Five Star converted from an S Corp to a C Corp and is giving their 93 pre-IPO shareholders access to the public markets. PowerSchool did their Up-C transaction, or is in the process of doing its Up-C transaction, to give its private equity backers the best of both worlds. And Ardius Acquisition is going to get a 20% stake in Origin's IPO for a nominal price. In my view, the common thread among these IPOs is liquidity. Now, that may not be the answer that we wanted to hear. As a Sacramento native, I would love to believe that there will be many more IPOs following on the 3 that we've seen at the beginning of this year. But I think, as we've seen, you don't need to be public to have a thriving business. And now might not be a great time to get into the IPO markets anyway. If you've watched the news lately, the SPAC market is slowing way down because investors are more skeptical of SPAC sponsors, or they're more skeptical that SPAC sponsors can find suitable acquisition targets. And in addition to that, inflation may spur a pullback from IPOs and equity investment generally. So I think we Sacramentans can afford to be patient. Our businesses can prosper whether or not they're traded on the NYSE or the NASDAQ. But of course, speaking selfishly, the attorneys here at Downey Brand, including myself and the corporate team, would be delighted to help with your public company needs or with your private company needs, whatever they are. So I'm going to stop there. I see that we have a couple of questions, and maybe Mary, you can help us cycle through those.
Thank you, James. We do have a couple of questions that came in. The first one is, which investment banks and law firms advised Five Star, PowerSchool, and Origin in their IPOs?
Great, thank you. This is an interesting question. So, as we've kind of gone over, the material in this presentation, there's sort of a dichotomy, I think, between the location of these companies and the advisors that they use. As a general matter, the banks that were advising these companies are located outside of Sacramento. So for example, I think for Five Star, it was Bruyette. For Origin and for PowerSchool, it was a consortium of investment banks that helped out, including Credit Suisse and Goldman Sachs. So not local, so to speak. And as far as the law firms are concerned, they were also not local. So I know that Five Star had Covington assisting them, which is actually really interesting. A former colleague of mine, Charlotte May, was included on the cover page of the 5-star S1. And we had worked together for years, and she's now with Covington in Washington, D.C. And for the other ones, PowerSchool, I think Kirkland and Ellis represented PowerSchool or is representing PowerSchool in the IPO. And then Cooley, which is sort of a startup or venture law firm, is representing Origin Materials. So, obviously a lot of different law firms involved, a lot of different banks involved, none of them local, unfortunately. I hope we can change that. I hope we can, show the public companies in Sacramento that we've got what it takes. We can do this public company work, and you don't have to go to Washington, D.C. Or Los Angeles or San Francisco to get high quality representation. So sort of a self-serving answer there, Mary.
Thank you, James. Another question just came into, and I think you may have sort of answered it a little bit earlier. It says, do you think we'll see a slowdown in the IPO market here in Sacramento and generally?
I think we're probably seeing it right now. As I said with the SPACs, I think the wave is sort of cresting right now. A similar thing happened, I think, back around the financial crisis with what were called reverse mergers. So there were a number of companies at the time. It was sort of another one of these financial fads where a public company would purchase a private company, and the private company would thereby go public. What happened with this reverse merger trend was, at first you have a few very high profile reverse mergers that get a lot of good press, and then there come a lot of imitators. And the imitators don't necessarily have the same backing, not necessarily the same quality of investment. And I think we're seeing that with SPACs as well. A lot of sort of very public high flyers at the beginning, followed by a lot of money after the fact. And so I think what we're probably going to see in the SPAC market is a slowdown as people become more skeptical of the ability of these SPAC sponsors to find good acquisition targets. Well, if that's all, Mary, thank you everybody for coming. I hope this was informative. Of course, if you have any questions about what we talked about today, feel free to email or call. I think this is a really exciting topic. I love talking about Sacramento's business community. So please feel free to reach out.